Take a moment, look at the disclaimer. This content is for educational, informational, and entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to spread the word of how BTA analyzes the market, how we look at the market. This is Rod from BTA, and we are known as the middle traders. We are not going to get in at the exact bottom, and we're not going to get out at the exact top, but we will. We are. We will. We are going to make a lot of money in the middle. Okay, this is our weekly walk with the market, part 2, y'all. You already know we got to walk with the market. We don't want to walk too far in front of it. We don't want to walk in front of it at all, because you might get yourself out there in front of it, thinking you see that bag of money, start running instead of walking. Get tired, run out of gas, never make it there. You don't want to get in front of it. You don't want to walk too far behind it neither, because then you miss the move. By the time you hear about it on the news, it's too late. Don't be watching the news trying to figure out what's going to happen in the stock market, because by the time they tell you, it's too late. Okay? They're telling you stuff that already happened in the past. It's too late. Okay? You'll figure that out on your own if you don't listen to me. When they tell you about it, the move is already over. You buy it then, boop, bop, bam, gone. Down it goes. Okay? All right? So, you definitely just want to walk with it. Stay in step with the market. Stay in tune with the market. Walk with the market. You definitely want to try to do that. And that's what we do every weekend. Try to stay in tune with the market. Well, we left off in part 1, all right, with these guppies. All right, and these guppies was telling us that the trend is still down. Short term trying to rally, but trend still down. Now, let's pick it up with the fibs. Okay, let's pick it up with the fibs. We're going to go straight to the weekly Fibonacci's, because that's the important right now. That's where we at right now on these weekly fibs. Okay, well, we spoke about this last week, and this week, walk with the market, nothing has really changed. You see where we at as far as the fibs. We're right here. Okay, that's this week's action. This is a weekly chart of the Dow Jones Industrial Average, the Fibonacci retracement levels for the weekly chart of the Dow Jones Industrial Average. Well, you see where we at. Okay, it's the same chart we looked at for the last 3 or 4 weeks now. Okay, we put our low, our Fibonacci retracement from the low of March 2020 to the highs back in November. Okay, that's where we at back in November of this year. Last year. That's where we at. Okay, that's where we put our Fibonacci retracement from. And right now we pull back. We settled down right at this 38% level. Okay, and we bounced off of that level. Well, what's important about that 38% level on this Fibonacci retracement? That little goldish, that little brownish bronze looking line you see there. Well, we got right below the 30. We got right to the 38% level. Right. This here line you see right here, that little brownish, bronzish looking line. But what's important about that? It held the high of March 2020, right before the corona collapse. That's this big, thick red line right there. That big, thick red line. You see that big, thick red line? Okay? That's the March 2020 highs. Well, the Dow Jones pulled back after this retracement. It retraced 38% of the move from the bottom to the top. It retraced 38% of the move, and it paused right at the 38% Fibonacci level, but actually right almost to the penny also of the March 2020 highs. And for the last 3 weeks, we've been above it. The next area of interest on the Fibs will be this level right here. That's the overhead resistance level at 2360, the 23% level. That's the 23% level, 2360. That's the 23% level on the Fib. So let's just keep monitoring this, because if If on this weekly chart we start rolling over and we break back below this fractal here, and we get back below this 38% level, and at that point we got to watch this March 2020 high level, the big red thick line. If we get back below that, that's at 29,588, the big thick red line. So if we roll over and break below that, I'm looking for us to come back and test this 50% retracement level of the whole move right here. And that's at 27,582. That's what I'm looking at right there. If we can't rally above this and go back and get above the 23% level up here, then I'm looking for this thing to try to roll over. And if we break this level and get a swing low with heavy volume and momentum coming in, then I'm going to look for this thing to come back to the 50% retracement level. That's the next area of interest for the Dow Jones Industrial Average. That's the weekly. Okay, now let's look at the Standard & Poor's 500. All right, the Standard & Poor's 500, okay, for the last 3 weeks, okay, has been holding right here at this fractal, right, which is the 3,723 level. I talked about that level. Remember I told you the old man Art Cashin, I told you last week, his level was 3,730. I don't know where he got that level from. I told you that before, but I know where I got my level from, 3,723, and that's because this fractal right here. All right, you see the horizontal line right here? You see these for about almost four weeks here, we consolidated, we bumped our head right at this line here, and we also got a fractal. It has support here. So this 3,723 level is very strong. And you notice for the last 3 weeks, it held support again. So this area has acted as resistance in the past, has acted as support in the past. Okay, here it was resistance. We got above it, came back and started acting as support. And now it's acting as support once again, this 3,723 level. But we're here to look at the fibs right now. Okay, so we got above the 38.2% retracement level right here. Okay, just like on the Dow Jones, the 38.2% retracement level, we got back above it. All right, can we rally up to the next level, which would be the 23%? Well, I don't know. But if this thing rolls over, break back below the 38.2, and then we break back below this level here, which is 3,723, well, I'm looking for it to possibly come back and test this 50% retracement level. If we break below that, then the March 2020 highs, this real big, thick red line would be the next area of interest. Okay, so let's just go over this one more time. We got this here. The 32% retracement level is what we gotten above for the last 3 weeks. If we break back below that, that's the 38% retracement level is at a key number we've been talking about and hollering about for weeks now. That's the 3,800 level. Okay, it's at the 38% retracement level, which we're gotten above right now. That's this line right here. Okay, is 3,814. We have broken below that a few times and we rallied up. I've been looking at the 3,800 level. Okay, well, the 3723 level is actually a little stronger than the 3,800 level, right? The 3723 level, you see, I already showed you that's acting as support and resistance in the past and has held support quite often right now in the present for the last 3 weeks, 3723. Okay, on the daily charts, we've been looking at the 3,800 level. This is a weekly chart. It's the 3723 level. Remember, the weekly charts are more important than the daily levels. We know that, okay? So if we break back below that, break below the 3,800 on the daily chart, break back below this 3723 level on the weekly chart, then the only other thing you got to look at is this fractal right here. That's the only other thing you got to look at, right? Another area of interest, and that would be at the low of 3636. We break back below that, that's a swing low. Okay, we break back below that, that's a swing low. I'm definitely going to be looking for the 50% retracement level, which is at 3,500 as the next area of interest if we break down below all of that. And if we break the 50% retracement level, then yeah, it's the big thick red line that comes into play next at 33.93. So those are the levels. Go back, write them down. Look at the chart. Recreate this chart for yourself. This is a weekly chart with the Fibonacci retracements on it. Recreate this yourself. Watch it. Don't trust me. Watch the numbers. Watch the numbers. Watch the charts. Okay, this is the NASDAQ composite. I said I wanted to see how this thing is going to react when it get around the 50% retracement level. Right now, from the March 2020 lows to the November 2021 highs, okay, we have given back 50% of this move, right? Because this is a 50% retracement right here. We are at the 50% retracement level, basically, okay? So this is where I wanted to see how the NASDAQ was going to react when it get around the 50% retracement level. Is it going to bounce and run up, or is it going to roll over and break below the 50% retracement level and try to get back inside of this golden pocket right here? The golden pocket, don't forget, the golden pocket is 61% to the 76% retracement level. That's the golden pocket, all right? In between this area, 61.8 and the 76, that's the golden pocket. But look what's right inside of the golden pocket. The red, big, thick red line, March 2020 highs. It's right inside the golden pocket. So if we fall back down here and we get a swing low, break back below this fractal, then when it get inside this golden pocket here, I will look for some sideways movement. The golden pocket can hold as really strong support levels on the way down, and it can hold as really strong overhead resistance levels on the way up. The golden pocket in between 61.8 and the 76% retracement level on the Fibonacci chart is the golden pocket. Are you picking up the jewels that I'm dropping? It's the golden pocket, okay? But right now, let's see how this thing is going to react around this 50% retracement level. You've seen the moving averages. You've seen the structural chart. You've seen the daily moving averages, okay? You've seen it. You've seen it already. This is the structural chart. We've seen the structural chart. This is the chart with the Fibonacci's. Let's see how this NASDAQ going to react right now, right around this 50% retracement level, okay? If it breaks back below it and we get a swing low, breaks back below this, I'm looking for the golden pocket. We get inside the golden pocket, I will be careful because we got the big, thick red line that's going to act as very strong overhead support, okay? Very strong overhead support, and that's at 9,843. That's the level of the March 2020 high, the big, thick red line. It's inside the golden pocket. It's going to act as some really strong support level. That's my area of interest. I will be watching it, okay? Now, for the IWM, well, it's pretty much the same thing as the NASDAQ. Only one slight difference is that the 50% retracement level, this big, thick red line, and the 50% retracement, the March, let me repeat this. I'm sorry. The IWM, this is a weekly chart of the IWM with the Fibonacci retracement levels on it. It's one thing that's different than with the NASDAQ. The IWM instead of the NASDAQ. It's one thing that's different with the IWM. The 50% retracement level, the crayon line, and the big, thick red line, okay, the March 2020 highs, the big, thick red line, and the 50% retracement level from the fib, the crayon line, is basically right here together. Okay, so if we break below and stay below and get a swing low on this chart of the IWM, that in essence is saying that if we get a swing low and break back below this fractal, prices go up and break back down and get a swing low on this weekly chart. In essence, it's saying that we have broken below and is trading below, okay, the March 2020 highs, okay, the big, thick red line, and the 50% retracement level on the Fibonacci chart. It's saying that we have done that. That's not good. That's not a good sign. That's some serious weakness there. And if that happens, then I'll be looking, if we get that swing low, I'll be looking for us to move back down and start testing the golden pocket. Okay, we come back down to the 61.8% retracement level, break inside that, and then we'll be in the golden pocket. The 61 in between the 61.8 and the 76% retracement level. And inside here, I would look for some consolidation. That's my next area of interest. But we got to watch this RWM, because if it break below the March 2020 highs, which is at $170.63, 170.63, we closed this week at 175. So it's only $5, right, on to the downside. But if it does that and it break back below the March 2020 highs at 170.63, then in essence it's going to be probably breaking the 50% retracement level, which is at 170.08. Is right there. So the 170 level, we break that, we come down and break this fractal right here, okay, which is at a low of 162.78. We break this fractal right here, then guess what? We break this fractal right here, that's a swing low, and then we're going to be trying to look at this golden pocket area as our next area of interest. So that's just something to keep your eye on, okay? Let's go now and look at the percentage of stocks above its 50-day and 200-day moving average. Look, the NASDAQ has been the strongest. Let's just start with the NASDAQ, okay? The NASDAQ is trying to test the red line here, which is the 40% level. Anytime the percentage of stocks above its 50-day or the 200-day drop below 40%, you got to be careful. When you're below 40%, good things don't happen when you're below 40%, okay? That's the red line, red light. Be careful. You might be in a correction or a collapse. Well, we right here, this is a daily chart of that percentage of stocks above its 50-day for the NASDAQ composite. This is a daily chart. Well, right on Friday, okay, we tested the 40% level, but it pulled back a little bit. So right now, 39% of the NASDAQ is now gotten back above its 50-day moving average. 39%. Does that sound all that like a superstar? Not to me. All right, but look at the NASDAQ. The percentage of stocks above its 200-day moving average. The 200-day moving average is only 15%, y'all. Only 15% of the NASDAQ is above its 200-day moving average. Only 39% is above its 50-day. So if this rally that the NASDAQ is trying to have, if it is going to have any legs to run or strength, you still got about 60% of stocks that still need to get above its 50-day. Okay? And look, yo, listen. And then you still got 85% of the stocks that still need to get above its 200-day. Is there any reason to fear? Any FOMO? Have the fear of missing out? I don't think so. I don't think so. If this market is going to rally, there's going to be a whole lot of stocks to buy that's going to go with it, because we know 75% of all stocks are going to follow the major market indexes. Look, for the that's the NASDAQ. For the Standard & Poor's, okay, the percentage of the stocks above its 50-day moving average is only 27%. Only 27% of the Standard & Poor's is above its 50-day moving average. You know the red line is 40. We haven't even gotten back to the red line, okay, to say that we're trying to get on the right side of the market with market breadth. Right now, just know only 27% of the Standard & Poor's 500, the big, large capitalization stocks, the biggest stocks in the stock market right now, okay, large, big companies. Only 27% of them are above its 50-day moving average, okay? No reason to fear. And as far as the 200-day moving average, only 19% of the Standard & Poor's is above its 200-day moving average. You know what Paul Jr. Jones said. If a stock is above its 200-day moving average, I'm buying, and I'm going long, I'm buying, I'm not selling, I'm not shorting. If the stock is below its 200-day moving average, then I'm only going to go short. I'm not buying. Or I'm going to sit my behind on the sideline and do nothing. The 200-day moving average is the line in the sand. Well, if that's the case, if we follow Paul Tudor Jones, which I try to do, Paul Tudor Jones is a really excellent trader. I take the man word for it. I've been following him for years. Okay? Well, if you do follow that, and you believe in that method, then why are you fearing? It's only 19% of the Standard & Poor's is above its 200-day moving average. It's a whole lot of stocks that got to do a whole lot of things to make you a whole lot of money if this rally is going to work. Now, look, this is the total U.S. market. The percentage of stocks above its 200-day moving average in the total U.S. market is only 14%, y'all. Only 14% of the total U.S. market. We track, when I say total U.S. market, I'm talking about the market, it's the stocks that we look at. A little over 10,000 stocks that we consider tradable, right? Because we don't be looking at penny stocks and all that. So when I'm saying the total U.S. market, I'm talking about the ones that are even worth even trying to trade as far as we're concerned, right? Well, only 14% of that. And it's only about 10,000, a little bit over 10,000 of those. Only 14% is above its 200-day moving average. Look, this little rebound rally that's going on, don't let these people on the news get you all worked up thinking that you're going to miss out on something. This junk is just getting started if it's going to work. That's if it's going to work. If it's going to work. The percentage of stocks above its 50-day moving average for the total U.S. market is only 31%. So only 31% of the total U.S. market is above its 50-day. And only 14% of the total U.S. market is above its 200-day. There is no reason to fear. This is not financial advice. But wouldn't it be wonderful if it was? Wouldn't it be great if it was? But it's not. But if it was, wouldn't lose a lot of money. Now look, this is our go-to. The creme, a la creme. The go-to chart for our market graph. If we follow this, I don't see how we could go wrong. If we follow this in lowest, because lowest would lead us to the promised land. We can't lose with the stuff lowest use. I know I haven't put up a lot of videos about lowest yet, but it's coming. We're working some things out. And then I'm going to show you something. I show you it every morning on the blog at browntradingacademy.com. Where you think I get that major market swing signal from? The percentage of stocks in a bullish upswing. Where do you think I get it from? Lowest. But right now, here's the advancing minus the declining stocks differential. The invisible chart. You ain't going to see it nowhere else because we created it. Okay, here, the green line, right, it's below the red line, the zero line. Okay, it's below the red horizontal line, the zero line. And it's gotten back below the red, and it's kind of trying to come down to the yellow line, the moving average lines. So the green is back below the red zero line, horizontal zero line, and it's breaking below the red, and it's trying to get down to the yellow. Well, that's not good for market breadth. That's not what you want to see when you're trying to get a rebound rally. I'm telling you, when this green line is below this horizontal zero line, good things are not really going to happen when it's below it. It has to get above it. It's not. Look, this thing, hey, look, every time we got this green arrow and it works the way and it plays out the way that it's supposed to, okay, this chart plays out the way it's supposed to, you already seen. We got over 70% chance of success. And I told you, I wrote the note right here. Notice the best signals are when the 21-day and the 50-day moving average are trending up. Where the 21-day is the yellow and the 50-day is the red. The 9-day is the green. When the green line get above zero and the red and the yellow are both turning up and we get this green arrow, when that happens, hey, we normally go on a good little tradable rally, if not a new bull market. I'm telling you, don't trust me. Don't believe what I'm saying. I'm just a guy telling you what I do. I could be a madman, completely out of my mind. Pay attention to the charts. Pay attention to the numbers. Men lie, women lie. Numbers don't lie. The charts don't lie. Here's the Standard & Poor's 500, the advanced decline, differential, invisible chart. You see that green line is below the zero line? You see that green line's gotten back below the red and the yellow? You see this green line is pointing straight down? And you think I'm going to go long the NASDAQ? Listen, or the Standard and Poor. Listen, I'm telling you, yes, we're in a bullish upswing right now. Yes, we are going on a little rally, but I've been telling you, even though we're in that bullish upswing, it's looking weak. The volume is low. The advanced decline differential chart is also telling us it's looking weak. It's looking weak. It's not looking powerful. This bullish upswing is looking weak. Weakness. Weakness is what it's showing us. I'm not saying it can't straighten up and go up. I'm telling you right now, I'm just going to wait until it do. Okay? And here's the NASDAQ, which is supposed to be the strong. Listen. All right, y'all. Y'all know I like to have some fun. But let's be for real now. If you've been reading the blog that I put up every morning, if I'm healthy and God bless me with life and strength, and I'm healthy enough, I write that blog every morning. I tell you what Lois is saying the bullish percentage of stocks are. I tell you what Lois is saying the swing signal is. The major market swing signal. I know I haven't been putting up a lot of charts on Lois because I'm going to bring her out again in a few more days. Okay? We've been perfecting something. All right? So, but I'm trying to tell you right now that if you've been reading that blog every morning, it's a short read. I try to keep it short, tell you what's going on with the economic news and the reports that's coming out that we need to watch out for anything. But if you've been reading that blog, I've been telling y'all that the NASDAQ has been, as far as price movement, has been the strongest major market index right now as far as price move between the Dow Jones and the Standard & Poor. The NASDAQ has been the strongest. But if that is the case, I told y'all what is interesting to me. If that is the case, why is it that the advanced decline differential chart, our invisible chart, if that is the case, why in the world is this green line can't seem to start pointing up and it can't seem to stay above zero? If the NASDAQ is so strong, why is that happening? This green line, okay, should at least, at a minimum, should at least be staying above the zero line and kind of fluctuating, kind of trending up, fluctuating a little bit, at least a little bit, something. At least moving sideways. The thing is kind of trending down and it's below the zero line. Look, the yellow line is below the red line. The faster moving average is still below the longer one as far as the red and the yellow is concerned. The yellow is the 21-day, the red is the 50. Why is the advanced decline differential chart looking so confusing and so messed up if the NASDAQ is doing so well? I've been asking that question for the last week now. In other words, I'm telling you, I'm suspect of this rally. Until this straightens out and until we start seeing some volume coming in, I just can't, y'all. Are you picking up the jewels that I'm dropping? I just can't buy it under these conditions. Be careful. Be careful. See you in the next video.